Well, it is said that digital lending has increased financial inclusion in the country by over 50%, and 71% of Kenyans have, in one time or another, used a digital lending app to take care of their financial credit needs. 2020 was a difficult year for all businesses as they were brought to a sudden halt by the COVID-19 pandemic. Today, we want to find out what impact did the COVID-19 pandemic, either positive or negative, have on digital lending. Thank you for making time, Kevin.
You're welcome, and thank you for having me.
2020, what level of disruption did COVID-19 cause in digital lending?
Significant. Several things happened, and I'll split them into two. There was structural things that happened, and then there was what happened with the customers. So the first thing that happened was that the president, in his first speech, was very clear about how listing to CRB would happen. That changed our business models at that moment, because one of the key tools we use for scoring users is or customers is this credit reference bureau system. And then, of course, the central bank then issued a circular on April 7th that technically removed all unregulated lenders from the credit reference bureau. So that was a bit of a shock to the system. Initially, we all had to stop lending, because now we had to sort of think, what do we do, how do we do it, what is the new model to do. So so by the end of the year, because we are agile businesses, we're mostly startups, we're mostly in tech, we had figured out the way forward. And so by November, December, we were all lending again, or most of us were lending again, and lending to the very best of clients. So to the customer, that's what happened. If they used to get money from particular credit providers and hadn't displayed that tendency to pay on time, to be the very best of customers, now the only ones truly accessing our loans.
But let me pick on that point. What does it mean for financial inclusivity when you say only the diligent customers are the ones who have access to credit, bearing in mind that COVID-19 brought businesses to a halt and brought financial flow, also some instability?
Well, you remember, lending is a business like any other business. So because there was a lot of clients who are hit by the business, that affected our cash flows, because then a lot of people did not pay us back. Therefore, we did not have money to lend back to them. So that was the consequence. And so the way we saw it is, those customers that are able to repay us back, let us continue supporting them, because if they're still making or creating value in the economy and we can continue helping them, let's continue helping them. And so that's where we are.
By what percentage did you see defaults and non-performing loans in 2020?
I'll give you a hypothetical. If defaults were at 10%, by March, April, May, they were probably at 60, 50, between 50 and 60. Because of what is called strategic default, those customers that decided, because this has happened, we will not pay. And then, of course, there were those customers that were truly affected by COVID and could not afford to pay.
And if you look at the World Bank Economic Survey of 2020, it says that those working in the informal sector lost about 30% of their income. But if you also look at that sector that you've mentioned, 33% of them do not want to go and get credit from banks, which means they would prefer
It's not that they don't want. It's the banks don't give them. It's very different. So it's not that they don't want. I think every entrepreneur, particularly in this market, if you've been in business for over 2 years, at some point your business needs extra capital, right? And everyone knows how difficult it is to get money from a bank. It doesn't matter if your business is profitable. It doesn't matter if you have the right cash flows. Banks just take long if they don't know who you are, etc., etc., etc. So it's very inaccurate to say that they don't want to go to the bank. They can't go to the bank. And that's why we came in. The innovation we created is that, one, we are able to identify the informal sector entrepreneur, and two, we are able to deliver the money they need as quickly as they need it. And that is the innovation.
The innovation also comes with a downside, which has been spoken about many times, and that is the charges that are levied upon every borrowing that you make. Let's take a standard, I'm sure, 7.5% a month. about 395% a year, Tala 152, branch about 170. Aggregate market lending for digital lenders is 520%. If you're lending to that demographic that you're saying you're lending, the margins of profit are very small.
That's again inaccurate. When people take our loans, you're comparing apples and oranges. Our loans are not year-long tenors, right? So an APR, which is what you've quoted, 500 and whatever percent, that is when somebody takes a loan for a year plus, right? We give our loans daily loans. We have daily loans. We have weekly loans. We have monthly loans. The mamamboga takes our money, goes, creates value, pays us back. In fact, if you default on a Tala loan today, for example, you'll pay, if you're at 10%, right, and you default after 30 days, and you don't pay the whole year, the most you'll pay is 13%. Right? So then that's why I keep telling people that is wrong. Let's not compare apples and oranges. When a customer takes a loan and repays, that's when they pay the interest rate.
So just to get what you're saying clear, digital loans are short-term loans, daily, weekly, monthly. However, we cannot still ignore the fact that even at that monthly rate, it's being charged at 7.5%, just about 3-5% short of what banks charge annually.
Yes, but a bank has to follow prudential guidelines, right? So they're limited they're limited on how they can price their loans, right? So that's number one. Number two is the market we lend to actually makes a lot more money than people realize. So a mamamboga's margin is up to 100% most of the time, right? So what they do is they typically just price our money in. If you take one of the digital lending loans that give daily loans, which is 1% a day, right? It means that a mamamboga can go buy 2,000 shillings worth of goods, sell them at 4,000 shillings, and pay us back 20 bob. Right? Look at it that way. But if you annualize it, of course it sounds insane, but there's no one taking our money for a year. Everyone takes our money for short term. It's working capital finance. Mm-hmm. Even Coca-Cola takes money at 2% a month. Mm-hmm. I mean, that's how it works.
Okay.
Yeah.
And that also brings the question of the Central Bank of Kenya Amendment Bill 2020. It was yesterday, or rather the day before, Thursday, last week, it was taken to Parliament and it was given an nod. It will go to the Financial Committee. And there are certain changes that are to be made to it. For example, one of them, a certain legislative member is seeking to ensure that the CBK can regulate the interest rates that are charged when lending out money. Do you think this is a forward step, or do you think it will be like the rate cap that was placed in 2016?
I think we need to remember that Kenya is a free market economy, and free markets are the most beautiful thing ever invented. And the moment you start tampering with price, you know who suffers? Mm-hmm. The customer. So if the customer is, if the Legislative Assembly continues pushing the narrative that pricing caps is what the market needs, what they've done is they've basically taken away the ability of that consumer that they think they're protecting from accessing finance. Why? Because then it won't make any sense to do business in Kenya, and we'll all move, right? And this has happened before. When the banking system was given rate caps, we all know how SMEs suffered, right? Now, this time, if you put price caps, it's not just the SME, it's that mamamboga, it's that boda. So we need to remember that we're in a free market economy. The central bank has also been very clear that we are in a free market economy, and they do not intend on touching prices. However, the complaint that prices are high is actually something we're listening to, and we've been also very clear that some of the pricing is as a result of systemic issues, right? The cost of transactions in this market is very high, right? And if we're sending 2,000 shillings and we're being charged almost 22 shillings per transaction, we have to pass the charge to someone. The cost of fraud prevention tools in this market is very expensive, and the cost of accessing services like the CRB could be lower. We have to pass those costs to the customer, and that's what sort of puts that price issue. Now, the CBK Amendment Bill is a good thing. The Digital Lenders Association of Kenya wants the digital lending sector to be regulated. The reason we want it to be regulated is because it de-risks our business models. And if it de-risks our business models, we have access to more wholesale lending cash. So if you thought right now we're doing 1 billion shillings in lending or 2 billion shillings, once the regulation is in, we'll be doing 100 billion. And that's where we want regulation.
Looking at 2020, how much or how volumes of transactions did you see?
No, we dropped, I think we were, pre-COVID, we were doing between 4 to 6 billion a month in lending. By March, April, it was next to zero. And then by November, we were now at 1.1, 1.2 billion as an industry.
Would you attribute that to the reopening of the economy by the president and the slow resumption of the new normal?
No. I'd say it's because we had to adapt our models and we went into the market to figure out how our customers are surviving and rebuild those new models and then started lending to the best customers.
What more can the government do to inject liquidity? We know like President Uhuru Kenyatta gave out a stimulus package and they've tried to put forth some economic measures which were revoked on the 1st of January 2021. What more can be done to inject liquidity into the market?
I think the government's prerogative is to ensure that all citizens are catered for. And for the economy, what I think is necessary is consultation around taxation. A lot of the tax initiatives are done without consulting industry, and you'd be surprised. Industry knows how to tax itself. If you asked industry and told us, where do you think we should be taxed? We'd tell you, if you did this and this and this, you would get X amount of revenue for the government and for us. And there's precedence for this in this market. So it's not something that hasn't been done before. So my thing would be, if you want to increase liquidity in this market, is make it more predictable to do business and make those tax initiatives a consultative effort so that once we agree, we lock in a tax initiative for the next 10 years. Because the other challenge we have with Kenya is 2021 is one tax regime, 2022 is another. So you can't plan 5 years, 10 years into the future like in more advanced economies. And that's what we really want. And the ability to plan far means that I can invest more now.
Thank you for making time.
You're welcome.